Hi, welcome back to my channel. This is Ben Morales, your personal financial coach. And here we are. It's that time of year. A lot of people are going out to lenders, see lenders and banks and different kind of institutions looking for money. They are out there asking for money. Christmas is here. Many people are just trying to buy gifts for their families and prepare for that special day, things like that. And what that causes an increase of debt. It causes an increase of a lot of people because of wanting to provide for their families and wanting to have that special moment. They get themselves into it and oftentimes have difficulty getting out of it. Oftentimes it takes them a complete 11, 12 years or months rather to get out of it. And then they start the process all over again, sadly. So what if there's better ways to borrow, ways that will allow you not to actually borrow? Okay, so that's what this video is about today. The question is, are you borrowing or are you borrowing? So when we go to the bank to ask for money, one of the two things is going to happen. We are going to either be borrowing or we are going to be borrowing. And let me explain what that means. So when we borrow, does it mean to borrow? Well, to borrow means to make a hole that will be used as a dwelling. That's exactly what is happening when you ask for a loan. You go, you ask for a loan. That loan actually becomes a hole for your cash flow. Your cash flow is stuck there, right? Picture it. You dig a hole, the item goes in that hole, gets covered up, it never comes back out. Right? It's like I remember having dogs and they would go in the backyard to dig a hole, and sometimes that bone or that item was never going to be found again, right? So that's exactly what it is like a loan. When you get a loan, you go to a bank and you ask for a loan, you are borrowing. You're putting it in a hole and it's going to be there hopefully for not a long time, but most of the cases it's there. Whereas in comparison, we could actually borrow. And when you do borrow and you do it the right way, what you're doing is you're taking and you're using it with the intent of returning it. And there's one particular product, okay, that we basically teach our clients to implement all the time. And that client, or that product rather, is a line of credit. So there's two main ways to borrow. One of them, okay, two ways to access your cash. One of them is your loan. Okay, what is a loan? Well, you take out a loan and it is considered a hole. Why is it considered a hole? Because it's closed. It's closed end. A loan, once you pay it off, the money that you sent into that loan is gone. You'll never see it again. If you were to need the funds that were in that loan, well, you'd have to go back to the financial institution, wherever you got the money from, you have to apply all over again. Okay. Now, in comparison to line of credit, and this is why we're talking about line of credit in this series, we take out a line of credit. It's open-ended, so it's a revolving account. It's there for you to use once and again. Okay. The funds that you use and pay off, they return back to you again because they're available for you to use again. That's how a line of credit works. Means that that's returning and it's always ongoing. So what I wanted to do is just let's take a look at what that looks like in a real life sample. Okay. So let's say, right, we talked about Christmas, we talked about gifts, we talked about big ticket items that may have to be purchased. So let's talk about, you're at a point in your life right now where you need to finance a project. Okay. Whatever the project might be, let's just say the $30,000, you can probably fit a vehicle loan with that $30,000. So let's say the $30,000 is going to be to finance a vehicle. So we're going to draw both scenarios. We're going to see which one it makes more sense. The first thing that we're going to have to do is we're going to have to change where the income, the $5,000 is going first. So typically we are taught that when we get paid every other week or every week, once a month, whatever the case might be, the money should stand or should be direct deposited in our checking account. Okay, that's another part of the whole, right? What is money in a checking account doing for you? Nothing. That money stays there and it sits there until you're actually paying bills. Well, if you're applying the line of credit the right way, then your actual income can serve as a payment for you throughout the course of the month as you are utilizing it for your bills and for your expenses, right? You're running your expenses through that personal line of credit, but you're also every 2 weeks, every week, once a month, whatever the case might be, making a payment toward that particular line of credit. And in this case, we have good enough cash flow here, 1,200, and we're going to see exactly how that is going to impact, because we're no longer going to be putting the money in the hole that is our checking account, and we're no longer going to be using a loan that is a hole for our cash flow. So let's say we're going to finance $30,000. There's a project that you have. It can be anything, right? But $30,000 is what you're going to finance. So you have to make a decision when you go and you're looking for financing. Are you going to make that decision? And is that decision going to truly be a borrowing decision, or is it going to be a borrowing decision? Is your cash flow going to be stuck in that hole and never be seen again? Or is your cash flow going to be returning to you and being used over and over again? So in this scenario, we're going to use a sample of $30,000. So it's going to be a $30,000 loan. We'll just say that it's going to be a vehicle loan. And right now, it's not too far-fetched to get a 6% rate. I see them at 6.5%, so on and so forth. But it's going to be a 5-year term. So with this particular loan at a 5-year term, your payment is $579.98. That is your monthly payment. That payment is going to be the same for 5 years, whether you make a double payment or not. Okay, that payment is always going to be calculated the same, because this payment, although it's simple interest, is still amortized. Okay, now that payment is going to take 5 years. It's also going to cost an additional $4,799.04. Okay, now let's compare that to a line of credit. That same $30,000 on the line of credit, and we're going to say that it's going to be a personal line of credit with a 9%. So there's a lot of personal lines of credit now that can give you 9%, especially if you have a good enough credit score. This particular sample, the person, what they had was $5,000 in income. Their expenses are $3,800. They don't have no debts, and that's what happens oftentimes when people, they find themselves no more debt. What they do is oftentimes they get into debt all over again, and they go and they get a loan, and that puts them right back in the same position they just got out of. So we need to change that mindset. Changing that mindset requires less loans, and when you do need to borrow, or when you do need access to cash, you do it in the form of a line of credit. A line of credit, same thing, $30,000, 9%. So let's stop right there. You look at it. Yeah, some of you are freaking out right now because you're at 9%. Well, why would you borrow at 9% when you could borrow 6%? Well, because one of them traps your money and the other one doesn't. Okay, this is the hole, and this returns back to you. So we want to borrow. We always want to have that cash flow returning back to us, and that's exactly what a line of credit does. So in this example, 30,000 again, 9% is the line of credit rate. Now, what I told you, using this strategy or using the line of credit to finance this $30,000, these are the numbers. This loan gets paid off in 20, or this line of credit rather gets paid off in 23 months. And the total amount of that is paid is $2,974.40 in interest. Okay, big difference. Interest up here was almost $4,800. Here is $2,900. There's a difference of like 1804.64. Why? Because in this particular loan, the money was put in a hole. Every time a payment was made, the money never returned. In this particular line of credit, the money was revolving, right? We can see that the cash flow was such in a way that it was allowing them to really, really make a difference in the speeding up of how quickly this loan gets paid off. We're able to pay off this loan in just 23 months. So this is the power of lines of credit. And this is why when you go ask for money, do it in the form of a line of credit. don't do it in a loan. Only do it as a line of credit because it's something that's always going to give you access to cash whenever you need it. Okay. The loan, if they needed another vehicle loan, they'd have to go back and borrow another 30,000 for another vehicle, whereas the line of credit is going to be available there for them to use once again. So I hope this helps you. If you have any questions, comments, concerns, please put them down, make comments, share any thoughts that you have. I'll make sure to read all my comments and get back with you. And if you need any help with this, if you need help, my contact information is included below. I'll be more than happy to help you through this process and really help you start paying off some loans, or rather some debt, more quickly and efficiently. Hey, we're approaching the next year, right? 2025. A lot of people are going to start doing New Year's resolutions. Please don't make your finances just a New Year's resolution. Get a plan of action together and make it happen for you. This can be done. You can pay off your loans. You can get out of debt. Make 2025 the year that you committed to yourself and to your family to do that. So with that, I will let you go. Thank you very much for your time, and I hope you have a very Merry Christmas.